Today we are going to talk about risk with special focus from the finance perspective. First, let's discuss the meaning of risk. Risk in general is viewed as a negative. Webster Dictionary defines it as exposing to danger or hazard. Chinese culture has associated two symbols for risk. One is danger and other is opportunity. So making risk a mix of danger and opportunity. It is from investment perspective, it is the variability of actual return from the expectance with a given asset or investment. Or we can also say it's uncertainty about future outcomes and the utility or benefit of those outcomes. Let's look at example. When someone ventures out onto a frozen lake, that person is taking a risk. Not just because the ice may break, but because if it does break, the result will be bad. And one should not also consider risk as only a downside. So doing that would be a mistake. Managing risk is as much about exploiting opportunities for gain as it is about avoiding downside. It is true that everything else, if held equal, more randomness is bad than the less randomness. The less randomness is good. We say upside risk is an opportunity, but believe me, downside risk is just a mirror image of the upside risk. So in terms of magnitude, the investors, if they take higher risk, they need to be compensated for that higher risk with the higher expected returns. And in general, risk depends on its distribution and the investor's preferences. Let's look at how to measure risk. In finance, we measure risk with the variance or in units by standard deviation. It is variance, it is the measure of the disparity between actual and expected returns. It is about how the data is distributed, how each observation is away from its mean. The variance is divided into two parts. One is firm specific and other is market specific. The market risk affect all the companies, or we may say it's economy wide, and we also know it as a systematic risk, a risk that cannot be eliminated. An example could be earnings and cash flows affected by macroeconomic risk factors. Macroeconomic risk factors are stat factors, just like expected term default risk. Whereas the firm specific risk affects only firm itself. For example, the firm might get some failures from any particular project. A project is unable to generate expected results. Competitive risk. It's about earnings and cash flows affected by the competition. A company can also get affected by its